Hello and welcome to Upside, where every week we dig behind the headlines that are going to affect European venture. Today we have a very special guest who I'll introduce in a second, and it's Mads and myself. And what are we talking about? We've got hot markets. How hot are they? Google's people moves. The UK has a 1 billion scale-up fund. We're going to ask Sion to dig into that. Plus predictions and deals of the week. Now, Sion, my good man, let me give you an intro and then you can tell me what I've got right and wrong. You are our fabulous guest of the day. You are the managing director at VenCap International. Now, for those that don't know, VenCap is a fund of funds based in Oxford, been around for about 40 years. They've committed $3 billion into around 500 funds globally with a portfolio covering. Now, I couldn't find any interesting business that one of your funds hasn't invested in. You lead the primary investment activity, which means it's your job to decide who gets the cash, which VC firms get the money. You're a mathematician, a CFA, a tennis player, an American football fan. Sion, welcome to Upside. Cue the applause. What? Thank you for joining us, my man. How are you?
Yeah, I'm good. Thanks, Dan. Mads, yeah, great to be here.
Thank you so much. And we were just talking off cam about how it's great to get the LP perspective on a lot of the news stories that we tend to cover on these shows. So thank you very much for joining us. Mads, what is happening with you? You're at the end of holes, aren't you?
Well, yeah, I'm heading back from Scandiland to London tomorrow. Looking forward to getting back there. Exactly.
It'd be lovely to see you. I feel like I haven't seen you in an eternity. So it'd be lovely to have you back in Londinium.
See you on screen all the time. But yes, you are right. Of course, in the flesh, we'll get together.
In the real world. Now, before we get into the main juice, let's do a little bit of wash up on last week. So quick scores on the boards. Mads, you highlighted Palantir as an interesting one to watch. So I know that there are quite an interesting story at Palantir. Also CXMT, you call the debut mispriced. What's happening? Tell us about both and give us a little bit of a wash up on last week on those two.
Look, it's summer months. I think markets have been a little bit quieter, but Palantir were up with earnings. And it's an interesting company because to some extent, they're positioning very much as the antithesis or the antidote to the frontier labs. They had unbelievable results. Okay, so revenue doubled on a year ago.
Unworldly. What did Alex call them? Was it otherworldly or something?
Something like that. And, some people sort of, accuse them of all sorts of things. So maybe there's some otherworldly things that are involved, but let's just stick to business and facts here. What's interesting is they started as primarily a government contractor, but the commercial business, so the non-government business actually grew the fastest. Government business was up about 90%. The commercial business, kind of the non-government piece, almost 150% up year on year. What Alex Karp, the CEO, is saying is that kind of if you contract with the frontier labs, if you send all your kind of your queries, your prompts over to Anthropic or OpenAI, you're effectively giving them your data, you're giving them your secrets, your deuce, your alpha.
So we should trust Palantir. Is that what he's saying? We should trust them instead.
That's exactly what he's saying. He's saying that his architecture means that the data stays on premise in your data center and is not going to go anywhere. And that means you're not going to leak away your business edge and comparative advantage. And it seems like lots of customers like the idea of that. The company's certainly growing very rapidly. So,
Sion, are you in Palantir? In any of your funds in Palantir?
Yeah, sadly not. It's one of the ones that got away, but wish we were.
You passed on the Beatles. Oh my goodness.
Certainly the AI train, it keeps rolling there. CXMT is another one, the Chinese memory company. We spoke about them last week. They've gone up further since then. Now the most valuable company in China. And as we talked about, look, just lots of retail money that wants to, and money in general in China, can't get out of China, wants to be in AI, wants to be in these hot sectors instead of pouring into this company. It is an interesting company. Now, there are aspects to the business we didn't talk about so much last week, which is that it's founded not long ago, 10 years ago in Hefei, out of a state program called Project 506, which is all about this region of China kind of backing businesses and trying to get stuff off the ground, a little bit like...
Sounds like Room 101, Project 506.
It's for the venture capitalists of the West. And so they are 250 miles inland from Shanghai, so it's not kind of a coastal city at all. 10 million people. They founded a number of businesses there. So BOE, which is the display maker, came out of that place. NIO, the premium EVs, also backed by the city there. And they're trying to put money into these things to stimulate them to grow. And yeah, just such a different model from what we see in the West.
What do you do in China, Sean? I know you do India, China, US, Europe. That's
exactly right? Yeah, so we've been about 70% US and about 10% each in Europe, China, and India for quite a while. And then for us, we've been in China specifically for almost 20 years on the venture side, and it's had some great results over the years.
How do you do it, Sean? Are you there? Is it boots on the ground? How do you work with China?
With China, a lot of those relationships have come where they've been the China arm of a global manager. So that's sort of like a nice way to initiate the relationship. But the really key thing is those decisions are being made locally in the market. And the same is true for, Europe or India or China. It's not the fact that people are sitting in Silicon Valley making those decisions. But then what you're sort of really finding is that, entrepreneurial talent is truly global and has been for some time. And on China specifically, it used to be, the bit of the quip that, they're just replicating what goes on in the US. But what we've really seen is lots of real innovation happening in China. And I guess sort of, one of the big ones as well is like the semiconductor sort of side at the moment. Things like, TikTok or by ByteDance, that short video, who's the big social media when it's come post Facebook, it's come out of China.
And I'm sure there's more to come. It feels like the tables have turned. That's probably the wrong turn of phrase, but they're now beyond copying Western models, Western IP. They're now building and building and doing their own thing. So I think there's going to be a lot more to come from China. It's going to be interesting to see. What else have we missed, Mads, in the wash-up from last week? Anything else caught your eye that we should cover?
No, I think the obvious question coming out of it is if the state is so successful bootstrapping and funding these businesses in China, shouldn't we just have much more of that kind of state-backed, state capitalism or whatever you call it? It's not quite socialism, right? I don't know what it is.
I was going to say, is it socialism?
It's kind of this strange new model. Should the state just be allocating the capital, and how come the Chinese can get away with it? It always seems to have failed when we've tried it in the West, right? The states tried to back winners, and it becomes Solyndra, right? It becomes Northvolt. It just blows up in flames. I think that the counterpoint is, look, there are definitely successes that Chinese governments at various levels, they back lots of stuff and a lot of it fails, right? They let 1,000 flowers bloom.
And they do it in a very aggressive way, don't they? The pattern seems to be lots of funding for lots of players, throw in some kind of Western catfish into the pot, like they did with Tesla for BYD, and then let the piranhas crack on. It feels like a very aggressive strategy. They failed at aerospace, though. They obviously succeeded with automobiles, but not done so well with the planes. But maybe, what next? Pharma maybe next? I don't know.
Aerospace and automotive, I mean, that's what we said about automotive 10 years ago, right? They'll never match Western cars. And guess what? I think what's interesting is that the thing capitalism does well is kind of there's the initial capital allocation, but there's also at some point, you stop, you run out of money and things blow up. And that's kind of that reallocation of resources, of talent, of capital to other more successful businesses. And I think the challenge we've had in the West is you've often had central government back stuff and you try to ordain a winner. And then it's like, well, sunk cost and we're just going to keep backing this thing until it's obvious it's not going to work. Whereas in China, you have, as you said, taken a much more aggressive approach to back lots of things. And you almost let all these different regions and cities compete against each other. So they become the market force, right? You got so much money, so much capital, you can play on the monopoly board. If you blow up over there, that's fine because we get somebody else succeeding over here and central government may or may not bail you out. So the model is a little bit different from what we've tried in that sense. The thing to learn certainly is that you need capital and you need to make lots of experiments and you need to try lots of things.
But they do thousands. They don't just do, like we're going to talk later with Sean, we're going to talk about the £1 billion growth fund and what's happening with that and how he sees the mega funds. But we just don't have that scale. And I don't know how, because they do thousands of car companies as an example. They do thousands.
When you say we don't have that scale, I mean, so let's test that for a minute. So yes, you're right. The Chinese population is what, roughly 2x the European population. Okay, so 2x the scale on people, but GDP per capita is lower. And I'd say Europe's GDP overall certainly measures up to China. So I don't think it's that they have a lot more resource than we do. You probably just think about it a little bit differently in terms of how aggressive to go after this innovation and the experimentation of trying new things.
Let's talk about markets very quickly. A quick check-in. The Stoxx 600 closed at a record 657 this week, roughly 10% up, although still obviously lagging behind the US. So basic resources, as in mining, doing well in Europe with semiconductors and banking. I love the fact that we're looking at semiconductors in there. That warms my heart. On the downslide, luxury goods, automobiles. Stellantis were down nearly 50% and energy not doing so well. Is the crisis premium really over for energy? I can't see that, but we'll see. The FTSE 100 hitting new highs, the S&P up, the Dow at a record close, fourth straight weekly rise. One stat that I liked, so the 5 best performing European stocks of 26 are all semiconductors. So Soitec, AT&S, Technoprobe, Extron, STMicro, all up in the hundreds of percent growth. Alphabet is now looking for another 25 billion in bonds, weeks after its first ever negative free cash flow quarter. Hyperscaler bond issuance is up nearly $200 billion. Through July, up 79%. So that's massive. So the debt is piling in and yields are now showing it, having to rise too high to match the risk profile. Mads, fill in the gaps on the market side. And then Sion, I want to come to you and see what your kind of take is on the broader, bigger public view.
Yeah, so just quickly on the Euro stocks and kind of the European semiconductor resurgence, because you're right, it's been driven by all kind of the fastest growing companies or the most rising companies are semiconductor companies. I think you mentioned in there, Soitec, AT&S, Technoprobe, Extron, and STMicro. And a lot of us can't necessarily tell what these do, right? They're not as popular, as famous as an NVIDIA. And digging a little bit under the hood, many of them do stuff that actually isn't growing that fast. Some of them even have declining revenue. And so what's happening isn't so much that they are growing leaps and bounds as some semiconductor companies have been doing, but that the whole semiconductor train globally has been re-rating the multiples on these companies. And that is maybe a little bit of a warning signal that just because they get thrown into the semiconductor bucket and maybe they're telling a good AI story, they're automatically getting repriced and priced up, even well ahead of any results. So this is not a kind of South Korean memory maker story at all. It's a bit of a different picture.
Sion, I know that you don't necessarily you don't do anything in publics, right?
Nothing at all, no.
No. Do you look? How do you kind of look for themes or trends, or does it guide any of the decision-making process? How do you look at publics with regards to allocation to managers?
Yeah, it really doesn't affect it that much as an investment decision. So for us, when a company goes public and when it interfaces with the public markets, it's the exit event. It's the end of the journey for us. If you back the company at an early stage, or one of our managers did, it might be a 10-year journey. So if you think about the companies or the money that's going...
If you're lucky.
It would be nice if everything went public in 10 years, but when I guess some things continue to compound the way they have, you sort of definitely not complaining from my seat. But thinking about like the new companies getting funded today, that money going in the ground, if they're really successful, it's a decade out before they really interact with those public markets. So it's not something we think about a lot in terms of themes. But it does, I guess, it sort of has a sliding scale of influence where if you're investing at the Series D or the Series F or the Series Z, I'm sure will be coming at some point soon, it has more of an impact. But those are more sort of things for our managers to worry about as opposed to us.
Mads, anything before we move on? Any other market roundups?
Maybe just SpaceX. They had their first quarterly announcement as a public company. Q2 revenue was up nearly 8 billion, up to 92%. Biggest component is Starlink there. They also have a big AI component today, $2.6 billion of revenue, but most of it is actually leasing data centers, kind of those big behemoths they built. So AI grew a lot, Starlink grew a lot, space grew a bit, 29%, so not nothing. But this is much more of a telco company today than a rocket launch company. In terms of how to price this business and where it should sit, nobody's got any idea. The analysts that cover the stock, they have a target that runs somewhere from $62 on the low side to $800 on the high side.
Whoa.
Okay, so it's really all over the map. And the truth is, it's got very little to do with the earnings today. You're buying into Elon Musk enterprises, and some people believe in the genius of the man and others don't. And that's effectively back to the good old story, in the in the short run, stock markets, they're voting machines, and in the long run, they're weighing machines, and we're very much in the voting phase of this.
What's there? Did you see any news on the lockups? I know that this week, we've started to see the first of the lockups being released, and I think they're going to basically tranche it towards the end of the year. And I'm wondering, and I saw a share price basically halved. I called it a few episodes ago that by Christmas it would be in half, and I think it pretty much is in half. But do you know anything about the lockups?
I don't think it's quite in half yet. I mean, you're talking relative to what, the peak or the
peak? Yeah,
IPO
225,
price?
and I think it was 110. I think it just dipped below peak. Not launch, no.
Yeah, I'd say I don't think looking at a peak price where some frenzy speculator bought one share at the peak price and then saying it's half of that is the same as saying that the price has halved. I think the IPO price is a reasonable benchmark, and yes, it was priced fully and full expectations when it came out. And I think you've said previously, look, you'd expect it to go down and climb back up, and it looks like that's some of what we're seeing now. Certainly the downward trend, because it's a story right now. There's just like the numbers are good, right? Doubling revenue is good, but you're still looking at a company that does kind of 30 billion of annually revenue versus a price tag of 1.4 trillion. So it's completely off kilter from a size perspective.
Yeah, I mean,
Sean, you are in SpaceX, aren't you?
Yeah, we got a pretty big SpaceX exposure, so I definitely take that $800 on that sort of high predictions. That would be a very nice day indeed. But I think like the way we sort of think about it generally, and this isn't really a comment on SpaceX, but we've been lucky to have quite a few big public exposures where managers have owned big percentages and big dollar values of public companies. And when it comes to the lockups, it's not a case of it's 6 months and then you dump the whole position, because I'm sure the CEO turn around and shoot you if you dump 10% of the stock on the market in one day. What we sort of tend to find is that they sort of get drip fed out over a period of 18 months, 2 years, maybe a little bit longer, really depending on how the stock is trading, what their view is of the stock, if they've got any MNPI and all that sort of stuff. So when you get a big concentrated position like this as an LP, we generally sort of see it as like you gradually get that liquidity back, as opposed to it being sort of all in one shot once the lockup's over.
I want to talk to you later about the performance of VC firms in not your stack. I won't ask you to expose them, but just to how you view the performance of venture as a group. Spotify, the 20-year overnight success story, has just hit 300 million premium subs, now turning a profit with a 33% gross margin, finally, mainly by putting some friction into the free tier, so making it very hard or very uncomfortable to be using the software platform for free. And interesting news on the stock price. They released these incredible stories and then it dropped 6%. Bending Spoons, the Italian roll-up, just bought Airtable for 1.3 billion. Now, that is less than the total amount invested over its lifetime. In December 21, the company was worth 11.5 billion. Are you in Bending Spoons, Sean, by any chance?
We're not in Bending Spoons, but we did have some exposure to Airtable. So again, I'd never get tired of $1 billion exit. To be honest,
yeah, I guess.
As much as I would have preferred a $10 billion exit, yeah, fine, whatever. But I will never get tired of the $1 billion exit. And the thing, again, thinking about what people might not see that we do see as LPs, is that when a company, raised the 2021 round at a very high valuation, and then the comps go down to the public markets, generally most VCs will write those down. So it's not a case that is in our books at 11 billion and then suddenly it goes for much less. And I think you're a little bit higher when you look at the equity value of the transaction. But it is something where generally these things come down over time. And given the number of high rounds that got done in 2021 and then where fintech and where SaaS and stuff has gone since, it's generally not a sort of massive day one hit when these sort of transactions get announced.
Yeah, I guess you're not exposed to the full shock of it. You kind of see the train coming down the track. MySpace is coming back. This was not one that I saw, and apparently others did. So user numbers over the last few years have climbed from 200,000. I'd love to know how active those 200,000 were in real money. But now they've grown to about 6 million. I think this is off the back of a recent documentary. Gents, did you guys have MySpace accounts? I did for a nanosecond. I don't know. Mads, I can't believe you had a MySpace account. No. For those listening, he's shaking his head in disgust. Sean, do you have a MySpace account?
I think it was the same one. I'm sure I did for a short period, but I did look for it a few years ago and couldn't find any trace of it.
You can get them. They're still there, or you can use an archive service. I did find my old one, but I can't. I think what they're trying to do is go against the algorithm. I think they're trying to go against the Facebook and the Insta and the TikTok grain and make it less algorithmically powered and much more showcasey, but I don't know what position they're going to take. Wave is now driving in London. They've only got 15 cars, but they've been licensed by TfL with their partnership with Uber. Humans in the loop still, so there's still a human in the driving seat. Now, one thing I didn't know, obviously Waymo, we do know are also in the pot in London, but Baidu is as well. So we're going to see at least 3 non-human operators in London relatively soon. Guys, have you sat in an automated taxi? Sean, have you been in a...
Yeah, I'm a big user of Waymo every time I'm in San Francisco. So I have been for some time. And it sort of shocked people, when I come back home to the UK, whether it's in Oxford or back home in Wales, and you sort of tell people, look, self-driving cars are real. Like, it's not a science project. It's not an experiment. It's like a service you pay money for, and it will drive you around San Francisco and various other cities in the US. It's a magical experience. Like, I've always sort of been accused of being a bit of a tech cheerleader by friends and family, and that's a fair cop. But if you haven't tried it, you really have to. It is quite incredible.
It's an interesting thing. Mads, have you been in one?
Yes, absolutely. And I mean, it's a great experience. Studies are generally showing that people will pay a premium to not have a driver.
As in to not speak to a random stranger?
Yes.
Gosh, I wonder what all the Uber drivers are going to do.
Well, I've already had the comment that actually the Waymo drivers are much better, safer drivers than San Francisco Uber drivers. So I don't know if that's a comment on Waymo or San Francisco Uber drivers, but again, that doesn't surprise me at all.
But isn't it because they do like 15 miles an hour through the streets? Isn't it like driving Miss Daisy?
They're getting more and more aggressive. Getting more and more aggressive.
That's a great experience.
I was surprised to see Baidu in there as well. I didn't know the operator. They're running with a very specific operator that I'd not heard of, but we'll see. There's now going to be a bit of competition in the pot, which is no bad thing. Finally, on the quick news side, I saw Apple has launched...
So what's interesting in this is that, yes, Wave are first to get a license, but it is, as you say, with a safety driver, whereas Waymo is close to starting to operate autonomously. We expect that Wave is probably at least a year, if not more, away from being able to do that.
Oh, I read it was this year, so you reckon at least another 12 months?
Yeah, Waymo's this year. Wave will be operating, but with a safety driver in the car. Right. Waymo obviously has safety drivers, but they're not in the car. They're remote, and it's not one-to-one. So it's a completely different model. So I still expect that Waymo is going to be the first place where you're going to get the complete autonomous driving experience in London.
Right. Okay. Who's the operator? Is it Waymo themselves? Who operates the business? Who's the app?
Yeah. So in San Francisco, it is Waymo.
It is Waymo. Right. Okay. Mads, your happy place. A bit on AI Corner. So just to tee it up, we spoke earlier about Anthropic building their own chips. It feels like everybody's now going full stack. They're doing that potentially with Samsung. Meta's Muse Spark model broke out of its sandbox during a security test and has now been hacking, along with Anthropic and OpenAI. What I didn't know was it's the same evaluation or testing partner, a company called Irregular, with the same misconfiguration. So maybe there's a story, maybe this is a nothing burger, but Mads, I'm going to come to you for this in a second. And we also saw the UK AI Security Institute published on Tuesday on agents inventing fake identities to socially engineer open source maintainer into approving malicious code. So there's an AI security piece here, Mads, that I'd like you to dig into. Where would you like to start on this one?
No, I think that's a great place to start. It's a really, really interesting story and angle, as you're saying. The UK AI Safety Security Institute, they ran some tests, last week between the 25th and 28th of July, 122 runs across 7 models, and 10 of those runs went off-piste. So effectively, across those runs, specific models, and it was Anthropic's Mythos and OpenAI's 5.6 Sol, so their flagship model, those models have been told that they were in a challenge environment. So what's a challenge environment? That's a sandbox environment where the model is meant to sort of strike out a bit and really be challenged and try and do crazy stuff. But in reality, the models were and had access to the open internet. So they were told they were in a sandbox environment, and the classifiers were off, the classifiers being the things that try and regulate what they do. but they had access to the internet. And what did they do? Well, one of the models found an open source project. So, for people that don't code every day, open source software is the software that's freely available that you can download and integrate into other projects you are running. And a lot of code runs that way. The whole internet is built on open source software. So it picked a project and then it created some malware being software that can maybe take over your computer, and then told the human maintainer of that repo that it was, had created some code that would update and upgrade that open source, and tried to push that into the repo so that the bad software, the malware, would become part of that repo. It then created sock puppet accounts, so fake accounts pretending to be real users that said, "Oh, I've reviewed this code myself and it checks out. I don't see any issues with it." And so this is all the AI doing social engineering to try and persuade a human maintainer of an open source repo to accept the code. Now, in the end, kind of a human maintainer, figured it out, shut it down. As the model was being challenged live, it started deleting its own tracks, covering up, and then in the end admitted that it had maybe tried to upload some code that wasn't good, but then you could see in the reasoning traces, so in its own kind of internal monologue, it was saying, well, I'm going to pretend to come clean so that they maybe will trust me more so I can come back and do this at another time. All of this done by the AI. So it's just super interesting to see what's happening. Now, some people are super upset, and there was another open source maintainer who said, I could have been the target of this. I actually think it's really, really important work because it highlights the risks and hopefully makes people wake up and say, look, we are in a new world here. You have to be much more alert.
But isn't this the point, Mads? The point is to test this. This mainly came from the testing agent. So wasn't this supposed to happen almost to a degree?
Well, the point is this. It did not happen on a test account. It is a real open source repo, and the people maintaining that repository didn't know.
Yeah.
I mean, so you could say, where do you draw the line? If it had attempted to hack a bank, if it had attempted to transfer people's money, if it had succeeded, like what? And this is sort of what gets some people's backsides up a little bit is sort of saying, okay, how far do you go with this?
Yeah. Sean, how AI pilled are you?
Yeah, I'd say pretty. We're sort of got obviously massive exposures through our funds. We're sort of big users of it here internally at VenCap, and even personal life. So we were talking off camera. I've just had a new kitchen. Lots of those designs were done by ChatGPT. You're just sort of taking pictures, trying things out. You just sort of fit seamlessly in it, and it did an incredible job actually. But then the one thing that we see with these sort of like cyber attacks is that we're also seeing more and more cybersecurity companies pop up in our underlying portfolio, because how do you sort of stop this sort of thing? You sort of got to fight fire with fire in a way. So again, it's like every sort of paradigm shift, you get a new attack vectors, and then there's opportunities for new companies or new products to sort of come up.
Yeah. It is going to be a bit more cat and mouse. And I guess it is the only technology that can resolve itself. So we'll have to work out if the intent is malicious or not, at what point. Mads, what else is in AI Corner this week?
Look, I think this was the key thing. And you mentioned Anthropic have started to roll their own silicon, which is also something we've been talking about for a while. They were leaning, of course, heavily on NVIDIA, but also using chips from Amazon and chips from Google. And they're now starting to roll their own silicon. And I guess the question becomes, okay, back to NVIDIA, what's been holding them back from pushing their own open source efforts more? And of course, the more their customers are rolling out competing platforms, the bigger incentive they have to just offer open source to the world. So this cat and mouse game certainly continuing to unfold.
It's quite well developed, their open source platform as well, isn't it? NVIDIA, they've been working on that for years.
They've been throttling it for sure. I mean, they could easily, it's not a frontier model, but I think they could easily get it there.
We've seen some quite unusual moves at Google this week. So Demis Hassabis is stepping aside as CEO of Google DeepMind. I'm not going to get his name correct, so please forgive me, but Kore Kovacoglu is now he's the CTO. He's now acting as interim CEO. Hassabis is moving to chair, chief scientist role, focusing on AGI and isomorphic. Some articles have been saying for a while that he's been stepping away for about a year anyway. Same day, Jeff Dean has left. He's been at DeepMind for 27 years with Sanjay Gemawat, Oriel Vinyals, who co-led Gemini, and Kwok Lee. Now, they've all stepped out to found a new business called Discovery Loop, which looks very interesting. It's a public benefit corporation trying to automate scientific research by running thousands of experiments in parallel. Google is investing. So the team is all leaving, and then Google is investing, which I guess maybe, keep it in the family somehow. And they're giving them compute for at least a year. Radical and Khosla are in too. Underneath it all, Gemini 3.5 Pro, they've missed their release date time and time again. So there's a little bit of shenanigans going on, perhaps. Is there a low morale? Don't know. Alphabet fell about 4% this week. Mads, do a better job than I just did about setting up the Google shenanigans and who's gone where, who they are, and why.
This is a big deal. We've said repeatedly, we think, or at least I think, Google is a really, really interesting and formidable player in the AI race. They were obviously early with this 10 years ago. They came up with the attention is all you need paper that your foundational research for the LLM. They then proceeded to build the chatbot internally and not release it. Jeff Dean has been talking about why. He said, we thought it was not a better search experience than search, so we just kept to search and shelved the other thing. And meanwhile, the engineers over in OpenAI stole a march on them. I think to some extent, you could say that what's been happening here is that the researchers, the scientists, Demis, the chief amongst them, are stepping aside, leaving room for engineers to take over, builders, people that ship product. But it is a big deal. I mean, Jeff Dean leaving Google is almost a little bit unreal. People that are in the industry may know Jeff Dean. He was employee number 30 at Google. He is, was somebody who was behind MapReduce, which is how Google indexed the entire web. He was behind Bigtable. He was behind Spanner, which is sitting under the things like search, like Gmail, like YouTube. He co-founded the Google Brain team. He pushed TensorFlow out into the world. Then he spent a decade on the TPU, cutting inference times by 10 to 30 times there. He was one of the two most senior engineers at Google. In fact, there are Jeff Dean facts about him. He's sort of seen internally as the Chuck Norris of coding. And he was absolutely a almost sort of an unreal superstar in that sense. And he's left with Sanjay Gemawat, who was the other most senior engineers. So the two most senior engineers at Google have now left, and they've been working on, who's who. If you look at who are the most cited people on the planet in AI and in large systems engineering, the new company they built, I think, have 3 or 4 of the top 8 most cited people in both categories.
But they didn't get poached for money. We've seen a lot of people in the great shuffling of the chairs running for cash, and they haven't. They've stepped out, haven't they, to build their own thing?
Dan Jeff Dean, he was employee number 30 at Google. I don't think he needs money. I don't think he cares about money.
For sure, but this is mission driven. It feels to me almost mission driven. It isn't. Then he's no spring chicken.
Precisely the point. I think there was probably maybe a little too much mission and a little too varied set of missions at DeepMind, where you had lots of people that were focusing on research and on publishing, and maybe not enough on shipping, which is why we're seeing all these delays we've been seeing to Gemini and why Google have been falling behind over the last 9 months. What does that mean? So Jeff Dean and Sanjay, they've gone off to build a public benefit corporation doing scientific computation for scientific research. Meanwhile, who's taking over? I think you're right. I mean, it's not the easiest to say. I get it to be something like, so it's Kore Kavokchuolu. I think it's
much better job than I did. I'm going to go with yours. I'm going to dub mine with yours.
So he joined DeepMind in 2012, and he was part of the team that built the model that learned how to play Atari games. They could play all 49 Atari games from raw pixels alone, which was the seminal paper that led Google to buy DeepMind. But he's not just an academic. He's been the chief AI architect. He built WaveNet, that is the thing that's making synthetic voices that stopping them sounding robotic. He's been working on lots of projects at scale, assisted maps, voice search. I think what Google is really trying to do here is to say, look, DeepMind was a beautiful thing, but now we need to ship. So DeepMind no longer has a CEO. That title dies with Demis. Corey, he will be a senior vice president reporting directly to Sundar. The idea here is let's get back in the game. Let's build the models the market wants and let's ship.
So well, I guess we won't know, but they're not bringing a new person in.
I would be surprised. I mean, where would they could maybe try and go poach somebody from OpenAI, but Google probably has a deep enough bench. I mean, they've been hiring all the best for decades, right?
Yeah. No, I'm pretty long on Google. I think they might end up shining after all of the frontier shenanigans. Sean, do you have any thoughts on this?
It's a big deal. And sorry, Sean, coming back to you in a minute, you look at the resurgence of AI labs and companies in Europe, so much of that concentrated in London, so much of that directly related to Google DeepMind spinouts. So it's been such a powerhouse. And I think that there is a bet now that it will be a different culture going forward, and we're going to have to see what that means for the organization. Hopefully Google can be back in the game and really challenge and compete at the frontier.
Yeah, I mean, DeepMind isn't Google and Google isn't DeepMind, and I don't know where the lines are drawn.
They are absolutely no. They are Google isn't DeepMind. DeepMind is Google. Google is DeepMind.
Of course.
DeepMind will no longer have a CEO. The leader of DeepMind will report directly to Sundar going forward. So,
but it's not like they're going anywhere. As in, they're still. I think there's still a lot to do, and I think this is just a slight twist in the story. We'll see.
Yeah.
Sean, what have you any thoughts on this one?
Yeah, I think the way that we sort of see it is that it's talent going from the Google and the public market, which is outside our universe, into the private markets, which is. So it's sort of quite exciting to see talent flow that way. I mean, Google was in our portfolio back in the day, but it hasn't been for a long time. So yeah, it is sort of nice to see things going over this way. And then, again, put in my sort of, primary sort of hat on, you sort of look at our managers and say, look, are they the sort of people that will be able to underwrite this sort of opportunity where it's sort of, the top of tier one level talent looking to build big things? Are they able to, underwrite it? Are they able to, convince someone like Jeff Dean to work with them? And so again, these are the sort of things that we sort of think about when you see these sort of headlines. Any sort of assessment on the company is just, probably not for us.
Let's get into your world, Sean. Let's talk about the title of this item is the £1 billion UK scale-up fund, but I'd like to broaden that to the kind of the UK venture scene, but just to tee it up a little bit. The UK Scale-Up Fund, this £1 billion fund, is a government-led initiative calling in pension providers such as Railpen, Nest and Border to Coast. It's not live. It was announced, I think, by Burnham. It was one of his semi-crowd play or part of the crowd plays early doors when he joined office. Some of the participants have stated that they've made a commitment to explore, which I don't know what that means, but this is now in the public domain. Sean, talk about this specifically, this one thing, if you have any thoughts on this, and also how you view the broader market. And I'd love to, I know you've got some performance data. I know you know this world very well, but as an LP, how do you see the UK specific venture scene from the mega funds all the way down the stack? To start wherever you like.
Yeah, I think the interesting thing, just like always at the top of our minds at the moment, is that we're getting more and more UK exposure and European exposure as well, more generally, but from our US managers. So, like we've got, again, people are coming over here because they're seeing the talent. Things like 11 Labs, things like Synthesia, Allegora, Mistral. These are all people with, American funds on the cap table and not just at the growth stage. So, we see that as a big validation of the market when you've got people that are looking for global winners or choosing to spend time in the UK. But then sort of, I guess, one of the corollaries of that is that there is lots of capital for the best companies. So that's true in any sort of major market. So when you sort of say, look, there's going to be a new entrant, it's going to be coming into a very, viciously competitive market as opposed to it being a sort of, untapped opportunity. So again, that doesn't make it any different from any other venture fund, because if there's a sort of part of the venture market where there's no competition and things are easy, I've yet to find it. So again, it's going to be an interesting sort of thing to see develop.
A question for you both. Does the UK need a growth fund?
Absolutely. We need more capital all the way up and down the stack, from post-IPO to pre-IPO to growth to CBA the whole way,
Yeah.
because
Yeah.
there is capital at the earliest stages, but if those companies can't graduate to raise follow-on rounds, the market, the ecosystem is not going to develop. And to Sean's point, yes, of course, there's money in the US, but it's always going to be hard from Sand Hill Road to, diligence and pick companies. And yes, the very, very best companies, the top, 5% will always get funded. But you do need to let 1,000 flowers bloom. You do need capital to reach more things and more places for the whole stack to work. So I say absolutely yes.
Yeah, I think for me, it's like the more interesting part of this is catalyzing the sort of the pension fund or the LP community. Because again, you do see lots of capital in the UK, but it being US managers, it's coming like that. Those underlying investors are from the US. That's where the gains are accruing to. And I think like the problem with venture is that it's a very different part of the market to just about anything else. When we talk to people that haven't spent any time there, the first step is basically unlearn everything you've learned about investing in public markets or in buyout funds. It's a very different beast, but it's also a very small niche of the market. So if you've got your private markets portfolio, of which venture is 10%, you're probably not spending that much time there. And if you're an institution that hasn't done venture before or hasn't done it for a long time, it's sort of hard to sort of go up the ramp. I mean, I've been investing in venture funds for over a decade now, and VenCap as an institution has been doing it for almost 40 years, and we still find it really difficult, and it's all we do. So if you're,
what's unpack that a bit, Sean. What are the challenges, or maybe some success stories and some failure stories without naming names? But unpack that a little bit for us.
I think at a really high level, there's data coming around from Carter. They do a nice job with some of releasing their benchmarks, and people have been looking at the performance numbers. And Dave, our CIO, posted this on Twitter, got quite a few reactions. Like the numbers aren't that great, to put it mildly, and everyone knows like the median venture fund.
Carter's mainly US data though, isn't it?
It's mainly US data, and it's mainly smaller funds. And you can look at Cambridge Associates or PitchBook or Preqin or wherever your favorite benchmark provider is. But it's sort of the performance you see in the benchmarks doesn't match up with what you see in pitch decks. It's quite startly. Maybe if you're in the top,
we're going to do 5x. Everything's 5x, baby.
I've seen people promise 10x on their first time fund. Maybe they will. Who knows?
Did you sign them up? I'm assuming you were throwing money at them.
How could you say no with that sort of projection?
Exactly.
but it sort of comes to the fact that the venture ecosystem is so skewed. If you're not in those sort of top quartile, top decile funds, it's really hard to make it work. And it's sort of very easy to go in, and we've met people that have done this as an allocator. You go into venture, you back a load of median funds because that's what you'd probably expect statistically. And you say, well, this doesn't really work. So we've taken a load of risk. We've had massive illiquidity. Why are we not just putting this allocation into lower mid-market private equity? So I think like the hard bit just comes through in that performance data. And that's always going to be the case.
Yeah, and I guess bonds are now really attractive, and other vehicles are now really attractive for investors as well. So, how do you make decisions? What are the key things that you look for? The things that maybe aren't so common knowledge when you're looking at firms.
Yeah, I think like the way we do the venture world is sort of really quite simple, and there isn't any sort of like magic diligence question or silver bullet that will sort of get you consistent performance. The things that sort of keep on driving the industry at an industry level in terms of performance is those top 1% of exits. It's the top 20, 30 IPOs or M&As of any given year. They tend to be the majority of exit value. There tends to be a pretty small group of VCs that can consistently back those companies. The other interesting sort of component of it is fund returners, where if you've got one company returning at least the entire committed capital of your fund. Again, venture's an outlier business. This would be that exemplified through that. But when we look at our data, about 90% of our funds that are doing over 3x net have at least one. So again, it's sort of, do you think you can partner with the world's best companies, or do you think the manager assessing can? Do they have a track record of doing it, which is normally how we like to look at it? And are they able to do it in such a way where it's meaningful for their fund? Because if you're able to put, a small check into a very late round of a great company, that's a nice logo, but it's probably not going to translate through to fund performance.
How any themes or trends that you're looking at? Maybe China, America, India, Europe, UK. Any themes or trends that are kind of driving your strategy at the moment?
The interesting thing for us is that we sort of view all these trends, whether it's sort of sector, so lots of investment at the moment into the sort of, physical AI, semiconductors, networking equipment, all this sort of stuff, different geographies, but we're sort of passive consumers of that. if that's the right way to put it, because what we like to do is back generalist managers, and they'll tend to go where they see the best entrepreneurial talent. So it means that you get early exposure to, the LLMs. So we were in early rounds of OpenAI and Anthropic, which we're very happy about, but we had no AI thesis at the time. We were underwriting the funds that did that. It sort of helps keep us on the front foot in a sort of convoluted way, because we're sort of, leaving ourselves open to sort of backing those emerging trends. The same is true for geography. The reason we went to Asia 20 years ago is because lots of our existing global managers said, look, we see a great opportunity. We see the talent. We're not going to say, actually, now's a great time to be, backing entrepreneurs in Beijing or Bangalore, as opposed to the UK or San Francisco. So again, like, we sort of see all these trends, but a lot of what we focus on is just, are you able to consistently partner with those best entrepreneurs?
No, that makes sense. Coming back to this £1 billion UK scale up fund, what are your thoughts on this specifically?
Yeah, I think for us, and before this sort of podcast, we sort of like cut some of the data we've got, because we tend to back established managers. They tend to have larger funds. So if you look at, we looked at the 2010s, so we looked at 2011 through to 2020, we had 17 funds that were over $1 billion. So dollars, pounds, blow your eyes a little bit. It's a mixture of early stage and growth stage, and obviously $1 billion fund investing in 2011 is very, very different in terms of environment to 2020. But just as sort of like a simple cut, what do these funds look like? And the interesting thing is, they're performing pretty well. Like, as a cohort across the decade, it's sort of 2.8x net. So you're almost at that 3 mark. We sort of projecting them out to get roughly in line with that sort of 3.5 times, which is roughly what we'd expect from this sort of cohort. So again, performing really well. There's 40% of those funds are over 3x net. There's 2 of them that are over 5x. There's none of them that are losing money. So you sort of look at it and say, well, look, $1 billion funds, they work. This is great. But there's sort of, when you dig a little level deeper, you sort of see just how hard this sort of stuff is. So on a look-through basis, there's 759 companies. And if you look at the top 5, they're generating about a third of the total value. So right. If you're not,
power law and power law and power law.
It's power law, power law, power law. And if you look at the top 10 companies, that's almost half the value. And these top companies, it's things like, maybe a ByteDance coming out of China, a Databricks or a DoorDash coming out of the US. There's a big slug of OpenAI in there. And, these are sort of, the $100 billion plus companies. So if you take those out of the sample, then suddenly this is not going to look very exciting at all. And the key thing is, are you able to get into those key companies? And then going back to the power law and, the fund returners, there's 8 individual fund returners in this sample. So with those 8 fund returners, it's not that 8 of the 17 funds have 1. It's that 3 of the funds have 2. And there's another couple sort of floating around there. So what it means is that, this cohort has performed exceptionally well, or, pretty well at this point. Hopefully we'll get to that exceptional level. But it means that there's a couple of truly exceptional funds in there, and a lot of them that are sort of, that are doing good, but are fine. But it's power law at every sort of level. Again, so when we look at this compared to the, the £1 billion UK scale-up fund, I sort of look at that and say, look, this can absolutely generate and just our returns. Like, the fund size is a bit of a red herring in a way, where if you back the right companies, you can absolutely generate venture performance. The problem is, coming out of a much smaller market like the UK compared to like a global fund, you might have 1 shot, you might have 2 shots. And if you miss those 1 or 2 companies, you might end up being on the wrong end of these sort of benchmarks. And if you get those 1 or 2, you might be a hero. So, that is a tall task, but, no one has ever accused venture of being easy.
No, it's not easy. And the bank is pulling this all together, and we'll see who comes in and who makes the real commitments beyond the commitments to explore, in inverted commas. Mads, any thoughts specifically on the scale-up fund or the UK venture scene more broadly?
Yeah, I mean, it's just a bit of a reaction to, I think, Sion, and you also, Dan, you pulled out the point around the industry, kind of the mean return, the median return maybe not being very good. I think to some extent, it almost seems like there's some schizophrenia going on, because the industry we're in is that of backing, massive outliers, which takes crazy ambition, which takes a desire to go for it, which takes really a will to try and knock it out of the park. And so if a founder came to us and said, look, I'm going to build a company, I know that most companies fail. I probably won't build a unicorn. Maybe I can return the money you gave me or you invested with me, but the stats are saying probably not. We'd be like, I can't back you. I need you to show that you're going to want to knock it out of the park. Yet some people seem to suggest that if a manager who is in exactly the same ecosystem goes out and raises capital and says, look, I'm here to knock it out of the park. I'm here to aim for 3, 4, 5, 6x. I'm here to create a big fund. It's like, no, but that's not what the base rate says. And you like, guys, this is the game we're in. We are here to try and move the needle. And we all know that most funds won't be 10x returners, but that doesn't mean we shouldn't try and go for it. Obviously, you can't promise it. Everybody who's on either side of the table knows that it's not a promise. It's an aspiration. The founders that come to us are not promising us we'll get our money 100 times back. When we raise money, we're not promising LPs we'll give them 10 times their money back. But it's the aspiration to create something big and meaningful and ambitious, because that's what fuels our industry. And so I just get a bit confused when some people, they look back to the stats and say, but what about the stats? You can't possibly promise that. Well, the whole idea is, of course, you can't promise it. But if you're not trying to go for it, then what are you even doing? And this thing just confuses me a little bit. I don't know, Dan or Sean, whether you guys have other thoughts on
well,
that.
I'm going to hand that on to Sean, because you see this from a very different perspective, don't you, Sean?
Yeah, I think a lot of it comes on the credibility of doing it, because again, it's very easy to sort of like say, look, like we're going to go swing for the fences. We're going to try and get a 5x, 10x fund. But then sort of recognizing how rarely that happens, you've got to handicap that quite significantly. If someone's got a track record of delivering that sort of performance, of working with the founders that can help generate that sort of performance, then that's sort of much more credible. If someone can explain it quite clearly to the portfolio construction, how you would get your fund north of 3x, again, it's sort of something to sort of dig into. But then what it often comes out of is sort of naivety on the fund manager sort of side. If someone comes to us and they're sort of promising a 10x and they sort of don't really sort of realize how hard that is, again, you are in the business of outliers, but the distribution of fund returns tends to be a lot more on the normal sort of side compared to what you sort of get at the company level.
Fair. I think there is a, you kind of need to be, what's the phrase?
Get at the end to win it.
Smart, yeah, that one, but smart enough to give it a go, dumb enough to try. And I think we all know that power law exists, as we've just spoken. It's up and down the full stack. So you've got to go for it. Anything else, Sean, anything else on the specific UK fund or anything from your perspective that I haven't asked you?
Yeah, I think like the key thing for this as we sort of watch it is, who's going to manage this? Because I think that's sort of a very sort of critical point. Whereas, obviously the managers in our portfolio, we entrust them with lots of money. They raise billion-dollar funds. If it was one of them that were to manage it, you would say, look, this is looking in pretty good shape, almost by definition. If it was someone that doesn't have the experience of running, a scale-up fund or investing at this sort of stage, you could get quite worried. So I think choosing who is going to do it will be quite key. And again, the big thing for me is if this can encourage more institutions in the UK to look at venture properly for the first time, that's going to be a great thing.
No, it can only be a good thing. I think maybe coming back to the question I asked before, is like any capital at any level in the venture ecosystem is a good thing, even though the US is obviously dwarfing us. I mean, we look at just one company in the US, multi-billions compared to this 1 billion scale-up fund in the UK. And I just like to see more coming in across the board. I've got one prediction for you. Please shoot me in the face. I reckon Bending Spoons is showing us the way, and by the end of next year, there will be a European firm dedicated to AI roll-ups with a 250 million euro or more as its first target, sectoring industrial and physical AI. Sean, would you invest in a VC firm looking like that?
I think it's sort of be pretty off strategy for us, unfortunately.
That's a very diplomatic answer. I do love you. A few deals of the week. Mads, what's your deal of the week?
Olix, which is one you raised back in February, where they were raising at just over $1 billion. 6 months on, they're raising another $312 million at a $3.3 billion valuation. Boom. It's James
there's your 3x, Sean. There's your 3x. There we go.
Absolutely. Within 6 months, he's a school dropout from Yorkshire. He's a Thiel fellow. He still runs another company called CoolMind. It's a brain company he founded when he was 17. So he's raised more than $350 million across 2 companies, and he's not even 26. So well done, James, I think it's maybe interesting to look at what they are working on, which is a chip for the slow half of running AI. Now, when we're running AI,
Slow half.
you're writing the answer word by word, and the chip they're developing here is one that has no HBM, no high bandwidth memory, which is this scarce memory we're all trying to get our hands on. Now, on the other hand, it's too small in itself to hold one model, so you have to spread the model across hundreds of chips, or even thousands. So they don't sell a chip; they sell a rack full of chips. But it's interesting. It's made for coding agents and other agentic type of workloads. And because these type of workloads, they generate lots of tokens, and that's the slow half of the whole inference game. And so Olix, they've created a chip that can do that a lot faster. Now, it's important to say they haven't shipped anything yet. We haven't seen any benchmarks yet. So this is still it's all in the works. It's all in the labs, but it's great to see an interesting company getting money to go out and take a big swing at something really important.
No, that's great. Mine is there's an Amsterdam startup, I've got a bit of a fixation with batteries, Sean. You probably won't know this, but I'm massively fascinated by battery tech. So mine is a battery tech company. They're Or Energy. Now they are building iron air batteries that store power for days. They've just raised 43 million. I wish you every success. Right, gentlemen, I think we are done. Mads, before we head off, what's happening this week that we should keep an eye out for?
We're going to get U.S. consumer price inflation for July. It's landing on Wednesday, so that's an important inflation print.
Up or down? What's your bet? I reckon up.
Yeah. Don't forecast that, but yes, seems likely. CoreWeave is announcing on Tuesday kind of a big data center provider. They've got a big backlog. Can they make it grow? They're still running at a quarterly loss. Can they trim that somehow? Does AI infra demand turn into cash is the big question. Those are the two main ones, but we're still very much in the summer period.
Yeah, we've got the rest of August to go. Blimey, it's only at time of pod. It's only the 7th of August, Friday the 7th. Sean, what's on your agenda this week, or next week, should I say? Anything fun, exciting, personally or work-wise?
I think it's sort of seeing if the quiet summer period ever arrives, to be honest. It just definitely, it hasn't felt like
Do you get
anything.
a lull?
We always think we do.
I
think the last couple of summers we really haven't. But between closing our own funds, investing in new funds, all the information coming out, there's been no sign of the summer lull yet this year. So maybe next week, who knows?
No rest for you at VenCap. Well, good luck with the new kitchen. I hope ChatGPT did you proud and no doors fall off and the dishwasher isn't sellotaped to the ceiling. So enjoy your new kitchen. I'm hanging out with the kids this week. I've built a little app. I was telling Mads off camera. I used Claude to build an app to scour the local area and find all of the cool things to do with my kids who are 8 and 5. And I've published it. It's at whydon'twe.uk if you want to have a look at it. I built it in a few hours. Claude did all the hard work and it's bloody incredible. Okay, it errors and it's a bit buggy, but it's bloody good. And it finds things in my local area that I didn't even know existed. Listeners, watchers, thank you so much, and we'll catch you all next week.